Sorry about that. We had some technical difficulties. Hopefully that won't happen again. This is episode 21, so that's about 5 months of this program. I've really enjoyed it a lot. It's September 10th, 2017. It's getting colder here in New York. Summer's over. Hopefully everyone's back to work. I know I never left. Market was really weird last week. A lot of bad things happened that may not seem like so bad, but the yield curve flattened pretty hard. It's flatter than it's been in a long time, which I think I've explained what that means before. You all know what that means. There was some kind of flight to safety. So you saw drug stocks, which had been weak, recovering. They're traditionally seen as defensive stocks. And then tech stocks sort of fell, stocks that are seen as aggressive stocks. And then obviously you saw the same thing in gold, where gold rallied, and it's sort of alternative fiat. Bitcoin dropped. So you're seeing a lot of reversion to mean. The dollar also weakened, which is specifically bad for the US. Basically shows that either inflation will be low or growth will be low or both. Currency speculators try to have a so-called carry trade where they get carried interest, not carried interest in the tax loophole sense, but they get interest on their deposits, and they get a carry arbitrage versus the shorted foreign deposits. So basically a lower currency means that the speculators are less interested in that carry interest. So anyway, that was pretty interesting. Bonds also rallying is very weird. So a lot of weird things going on that would normally send a shiver up your spine if you were a speculator. I noticed Allergan did this weird deal where they gave some patent rights to the St. Regis Mohawk tribe, and basically they got to delay the IPR, the inter partes review. So I think I'm going to do that too for all my drugs, so that I can avoid litigation, which Congress intended to defeat obvious patents. So again, I think the reason I'm not going to hate on Allergan for doing this, I sort of hate on the media for not sort of exposing the double standard that exists. Allergan seems to get away with everything. They did a hard switch. They raise prices like crazy. They lie about the impact of their price increases, and this move, especially giving your patents to a Native American tribe when they had nothing to do with your medicine, is kind of a crazy to exploit their sovereign status. We'll see how popular this is when I start doing it. Acadia is a company that I'm short. It's been going up like many stocks, so I don't have any problem with the stock going up because I have longs that are going up as fast or faster. But they recently were in the news over a so-called M&A merger rumor from a larger company. I don't worry about this when these things happen because ultimately Acadia is trading at I want to say 40 times revenue, maybe 50 times revenue, and I don't think it'll ever be a major medicine. The last several schizophrenia medicines flopped. People like, for schizophrenia, the injectable products. The new pills are not too exciting. There's 1 million of them. There's not a lot of demand for a really expensive schizophrenia drug when there are so many available. But I think it's important to talk about scale. So if you have a company and in your model you have margins that are above normalized margins, you have to adjust for the fact that that's an asset that can be used oftentimes to add more products, and that you're operating at this super scale. But also, if you have a company like Acadia who has only one product, you have to adjust your model to make sure you're not over taxing the company, or if they're in a launch phase or something like that. So in essence, you have to normalize your models, and of course I've done that for my models. But I think oftentimes companies look at a company like Acadia, for instance, they're losing hundreds of millions of dollars. While that's important for the balance sheet, on the income statement, really this company won't persist in that state for a long time. So it's not worthless, but even under a sort of solid state or appropriately scaled model, the company's still a short. But I think it's very important to sort of think about that. A lot of people get scared when their shorts are M&A target rumors. That doesn't bother me or scare me whatsoever. Certainly companies can make mistakes. I gave the example of AstraZeneca buying Ardea for $1 billion, and that product is not selling at all. So there's certainly opportunities for companies to make mistakes. This is a $4.5 billion company, so it would be a $4.5 billion or more mistake. So I don't think that anyone's going to make that mistake. This is the kind of medicine a lot of people don't want to have. It's kind of a GP medicine, to be honest. I know they're selling it at a psychiatry specialty price. I don't think they'll be successful at that. So we'll sort of see what happens there. But I don't get worried about stocks that I'm short that are M&A, so-called M&A rumors. Again, stay diversified, try to find positions like this. It's my biggest short, but it's only 2.5% of my portfolio. If it got taken over, business would continue the next day. It wouldn't be a problem. I'm short Comcast. I actually doubled my short. They cut guidance, sub-guidance, which is their lifeblood on cord cutting, and they blamed Harvey as well. I think that we're seeing the beginning of the end of the telco sort of complex. All of these stocks are super expensive. They're all trading as if they'll never have a problem. Their debt is trading as if they're the most risk-free companies. Most of these companies are really over-levered, and they're desperately trying to get out of the delivery business and into the content business. Obviously, we know the AT&T Time Warner merger, and Verizon's been buying properties too. Comcast already has a ton of properties, but these companies are all over-levered and trying as fast as they can to get out of the content game, because the internet has sort of made content delivery so much easier, whether it's through Netflix or through your own website. Disney, for instance, launching their own service. So Comcast is sort of caught in the middle here, trading at over 20 times EV to earnings. Really ugly company. So when they cut guidance, the stock fell, but I've decided to short more, and I've also started to short Verizon, which has very similar properties. So, we'll see what happens with these positions, but I'm somewhat excited about them. Someone asked me to explain the TIPS spread and how TIPS works and Treasuries. So here on the sort of orange line, you can see the 10-year yield. So this is the 10-year yield. And you can see that bonds have rallied. That's why the yield's gone down. And you can see the Treasury, the inflation-protected security, the TIPS, has gone down in lockstep. So basically, the TIPS is yielding, you can see 0.28, and the Treasuries are yielding 2.09. So basically what that means is the inflation-protected security strips out the inflation part. So you can see most of the yield you're getting in a Treasury bond is actually just inflation. So buying a Treasury bond gets you 0.2819% annually, which is sort of the so-called risk-free rate. Now, again, it's not risk-free. This is the risk that the U.S. government does not pay you back, which would be quite a catastrophe, since the U.S. government not paying back China and Japan and Europe and the U.S. Banks and things like that would be such a catastrophe that basically the world would be ending. Now, I don't think the risk of that is zero, mind you, but I do think that you're not getting paid quite a lot for that risk, and buying these bonds is something that you should never, ever, ever, ever do, and that you're better off kind of, keeping the money in cash. But irrespective of that, you have to find ways to fight your own inflation. Again, headline inflation is not that relevant in my opinion. And I've a lot of deep thoughts on this, but somebody wanted me to explain this, and so there you have it. Portfolio. Okay, so I included one of my hard assets on the portfolio for the first time, but all jokes aside, nothing changed too much. Let's see. Probably the biggest move was the Acadia move. So we had our first down week for quite a while. We're still beating the market somewhat nicely with a low gross and low net. I added 3 secret shorts. They're actually all the same company, but two of them are options on the company. So I'll leave it to you to play guessing games as to what it is. I'll kind of reveal it maybe next week. I doubled the Comcast, as I mentioned. I initiated the Verizon. Everything else is sort of the same. I'm pretty comfortable with all these positions. Again, I really like Regeneron. They have asthma data coming out soon. I think the product will do well on asthma data. I know the stock sold off a little bit on the AbbVie data, and maybe I'll do a deep dive into that next week. Let me just make a note to do that. Basically, AbbVie has a drug now for eczema, also called atopic dermatitis, and investors were a little worried that would hurt Regeneron since their data looked pretty good. I actually think it's good for Regeneron, and a lot of people don't understand this about pharmaceuticals, is that the more products in a space, the bigger the space grows. And it's really paradoxical because in other fields you think competition is a bad thing. The thing about eczema is there's never been a bunch of companies out there trying to get doctors to treat eczema. So even though you do have, obviously market share can only equal 100, the market is exploding for eczema drugs. So Regeneron is going to sell $5 billion of their drug, and AbbVie might sell $5 billion of their drug. There's so many patients that it doesn't hurt to have more and more salespeople and more marketing dollars telling doctors simply to treat eczema in the first place. So it's not like Regeneron would have $10 billion in revenue without AbbVie. So I think that you're really going to be just fine with Regeneron competing with AbbVie. Nothing changed much in Gilead other than it continued to rally. Avexis, again, I think this company is really a special company. I think this drug can do $2 billion in revenue. I know someone who emailed me said, "Isn't it starting to look somewhat expensive?" And I said, "Not even close." The company could do $2 billion in revenue, and that's probably worth about $20 billion in market cap, because most of that revenue is earnings, especially to, as I mentioned, a scale consolidator like a Genzyme or an Alexion. And those companies that would be a huge acquisition for those companies. This is about a $2.5 billion company right now. So I think you still have 5 to 10x potential in Avexis. Sangamo gets a little more attention than Spark and Unicure and BioMarin, but I like all of those stocks. I don't like Alnylam, which is also another hemophilia company, but it's important to watch that one. I might buy a little bit, but they just had some bad data for the hemophilia drug, so I kind of dodged a bullet there with my basket approach. But don't think that I like Sangamo more than I like Spark or Unicure. I like them all. So I see a lot of people kind of not looking at those 2 or 3 stocks, but they are only looking at Sangamo, which doesn't make any sense to me. On Taisho and GSK, these are really kind of low vol, safe companies. PTC has the Translarna DMD panel coming up. I fully expect that the FDA will reject Translarna. They should reject Translarna. It doesn't work for Duchenne muscular dystrophy. I like PTC for a mix of other reasons. There are other assets specifically. Innoviva, I think, is a really, really good long. I still have to do a little bit more work on this to size it up, and I'll do that in conjunction with GSK, who's their partner. It's basically a royalty holding company for the GSK asthma medicines, excluding Advair. Versarchus is pretty interesting. It's very speculative. This could be a 10x as well, but it's very, very speculative, and I'm not that close to it, so just keep that in mind. I'm selling the Wu-Tang album, as I've mentioned. This is not going to be a good return for me, although I gained some benefit from the CDs that are intangible. So I'll probably take a 20 or 30 basis points loss on it and move on. But at the same time, it got me the opportunity to actually buy Carter 5 for very little, and also I'll be buying Tupac, 10 or 12 unreleased Tupac tracks soon for very little. So sometimes, these acquisitions put you on the map, and more people in that esoteric asset class come to you. A little bit like some players do in reinsurance. So I have a good lock on the secret music industry or the unreleased music field. So I'm getting to see more deal flow in that field. It's very much a hobby for me. But the Wu-Tang sort of was a pretty big acquisition. I'm trying to sell this stock, as you may know, AudioEye. So don't buy AudioEye. Desperately trying to get out of this stock. It's the bane of my existence as a kind of semi-private holding. It's got the liquidity of a private equity with the none of the benefit of being a public equity. Let's go to the shorts. I've been so wrong on Weibo, it's ridiculous. I want to do kind of a post-mortem on how I got that one wrong. Again, when you don't know a lot about the field, this is Chinese social media. It's good to bet as little as you can, and by betting as little as I can, I've avoided any real losses in Weibo. Same thing with Tableau. This is enterprise software. I feel really bad because I know a lot about enterprise software. I feel really stupid on this one, so I want to do a little bit of a deep dive on that one. One of my analysts met with Co-Diagnostics last week, and it was as memey or as much of a short as I thought it was. Again, it's a very, very small cap, so you can't put too much money into it. But CODX, for anyone who has a small portfolio, this is, liquidity doesn't matter to you, so I kind of like that one as this company is worth absolutely nothing. Ironwood has been such a great short. I'm upset that I didn't get to short more, but it might be running its course. Twitter is interesting. I really think they're basically lying about their users and their user growth, and they have huge problems in their business that they haven't disclosed. So I like the Twitter short. I like the Comcast short. The secret short, again, I think some of you can guess what it is, but I'll have more on that maybe in a big expose next week. Nectar is sort of like Ironwood. I want to short more. It hasn't gone down that much. I just don't have the time to study it so carefully. To make it a 2% position, I really have to know it inside out. So we'll kind of see what happens there. Neurotrope is sort of status quo. Medicines Company has fallen. Sort of as predicted, it's been one of my better shorts. We'll see how Insight does. They raised money, or they're raising money, which is really weird. And they announced the Echo data, which was sort of in line. So we'll see. Neurocrine and Acadia are very similar. They're two new launches that I think will disappoint. And Bioverativ, as I've mentioned many times, is going to be disintermediated by the hemophilia drugs. So anyway, we lost a little bit of money. The rate of return is about 31%, but that's also without the gross adjustments. So with the gross adjustments, we're in the 70 or 80% annualized return rate, which is very, very good. It's sort of, we'll see kind of if we can keep that going. I think this short, the secret short, will give it a nice injection, a steroid injection. So anyway, I think I didn't do the news one for this week. This is just last week's. So nothing there. I'm kind of messing around with the format of this, so I hope you enjoyed it. Here's some fan art of me as the Pope meeting with Donald Trump, so thank you. And there's a couple of other fan arts of the new mixtape that I'm coming out with, so thank you so much. This was also carried over from last week, so I sort of had to do this one last minute, so I apologize for some of the older slides creeping into here. Chris asked a really good question about position sizing. I've done some slides on this in the past, but basically I think that if you do, if you start, just sort of a theory of ramping position size. And so my basic theory here is that as you exponentially increase your position size towards target size over a defined time period, you maximize IRR. So what does that mean? So let's say if you start with a 0.1% position and you go to a 0.5% position, maybe a 0.2% position, 0.5% position, 1% position, 2% position, and a 4% position, and diversification kind of sets sort of a limit here. And let's say this takes a 1 month. Let's say you expect stock A to double. And let's say it happens in 1 month versus 2 months versus say 4 months versus say 8 months versus say, I don't know, let's not make this so linear, let's just say 12 months. Well, you're trying to maximize your internal rate of return, which is your actual cash, not cash on cash return, but your actual theoretical return if all of your money were at risk. And why is this important? Well, if you don't have your money at risk, you can't lose it. So if you start at 0.1% and the stock doubles within a month, you're a little ticked off because you wish you could put 4% into it. But for whatever reason, you put 0.1% into it, but you got such a great return in such a quick time that you can now recycle that money. So your cash on cash return was 10 basis points, but your IRR is something phenomenal. So I think it's 1.001 to the, something like that, to the 12th maybe. So you got a 1, I think I'm getting this wrong. Let's see. It's a really, so it's a 1 times, I think it's times 2 actually, to the 12th power minus 1. So it's something crazy. It's like a 4,000% IRR, right? If you could double your money every month, it'd be really insane. So the same thing applies to this one, which is 2 to the, 2 to the 6, I believe, minus 1. So this is a 63, this is a 630% return, etc. And so anyway, the point is, I've done these charts before. The point is, so obviously if you double your money in 12 months, you make just the return that you expected, which is 100% return. So anyway, the point is that you're trying to gear for a higher IRR at the end of the day. I mean, you're always trying to gear for high cash and cash returns too, but you want to gear for a higher IRR as well. So basically, you can sort of try to titrate to your IRR. These returns are something more 300%. This is something closer to 150% or something like that, just off the dome, as some of my rapper friends say. But that's sort of the way this works. So you're a little upset, again, you only make 0.1%, but you do it so quickly that you can recycle your capital into another trade. So anyway, the point is I try to start slow and then kind of titrate up. The other thing that I try to do is think about what are the inherent risks in that position. So if you look at something like Taisho is all cash. It's like 75% of the company's cash. So if you think about the 1.4% of the portfolio that's at risk, only 20% of the company as enterprise value is enterprise value. So it's really a 28 basis point position. So it may look like, oh, you really like this stock Taisho. Not really. I'm basically buying cash. So the part of the company that isn't cash, I'm speculating on, but that's a really small percentage of the portfolio. Something similar thing with beta, right? So with beta, GSK is very, very low beta. It's about as low beta as you can get. The stock has not traded more than $10 in its ADR form, at least, in a very, very long time, maybe even a decade. So this is almost like cash in many ways. And the same thing applies to, a little bit less so, but it applies to Gilead. So, these are really, really not high beta, so you have to adjust for that too. So in any event, that's why I often say Avexis is a really outsized risk here at 3.3%. They have one product, there's no cash, super high beta, and I've put a big position on it. So if this does take 2 years or more, my IRR won't be very good, which is very important to me. Because again, the cash that I'm not using is very important, and it should be important to everyone. So I hope that helps a little bit. Michael asked a pharmacology question about serum protein binding. So basically, the way serum protein binding works is you have sort of a funny way to put it, but let me sort of draw the way it works. So you've got here's our patient, and this applies to everyone. He's got one bigger arm than the other. That's a weird condition. So the drug goes in, and it goes to their stomach, it goes through the liver, etc. And obviously it's getting absorbed into the bloodstream. So what's interesting about the bloodstream, let's sort of zoom in on that, and let's say here's our drug. And here's the drug particles floating around. There's a big protein, which we'll color in green, called serum albumin. And basically what serum albumin does is it binds the drug. So most drugs are 99% or more serum albumin bound. And so that actually removes them from the bloodstream. So when you take blood in a patient for, say, a pharmacokinetics test, here's your needle, and you get the blood, and you sort of see how much sample there is with serum albumin, you have something called a free fraction, basically. So when you're trying to estimate how a drug works, you look for free fraction. So this is the drug that's not serum albumin bound. So this drug that he was asking about is 80% serum albumin bound, which is less than you would normally expect. And you can get human serum albumin in a petri dish and see, test tube if you will, and see how much percentage it's bound. Now it's not a good thing or a bad thing. It just basically means that the amount you have to give is less than normal. Most drugs are 98% serum albumin bound. Albumin does a really good job. It's sort of like a roaming thing to bind xenobiotics. Xenobiotics being anything outside or foreign from the body. So it doesn't just stop. Your body has so many defenses. It's kind of amazing. You've got the stomach, which is low pH, which will kill anything, obviously alive. And you've got the liver, which can detoxify virtually anything, metabolize virtually anything, and then you've got serum albumin floating around, and of course the immune system. So it's really amazing how many things we've got to protect us. But in any event, when you have 98%, you actually have to, if you do the math, it's kind of interesting. So if you give somebody 10 milligrams of drug, and 98% of it, first you have bioavailability, a so-called F, the F figure. And so if your bioavailability is, say, 75%, which is a reasonably good bioavailability, you have 7.5 milligrams in the bloodstream. Well, hold on. If you have 99% serum albumin bound, you really have 0.075 milligrams in the bloodstream, which, if you think about it, is a really low amount. Now, if you look at the sort of Ki of a drug, you have to ask yourself how much, and how much can this drug really bind its receptors? So if you have 80%, you don't need maybe to give 10 mgs. Whatever, you sort of can extrapolate from all of this. So there's a lot of math to it, but serum protein binding is something I look at for every drug if I can see it. Simo and Byron asked me about Bitcoin. I have some opinions on Bitcoin. I think that I like Bitcoin. I've been using it to gamble, I guess, and play poker on the internet. So that's one app. That's the first app other than speculating on Bitcoin that I've been able to find, storing value and speculating on Bitcoin. So that's kind of a cool app. It sort of does what Bitcoin promises, which is this sort of anti-government, anonymity, unregulation type of concept. And so I still think the big problem with Bitcoin, from my own experience, is that it's very hard to buy. You can't just go on Amazon and buy, $10,000 of Bitcoin or $1,000 of Bitcoin, and payment processors can decide to crack Bitcoin whenever they want. All that has to happen is the U.S. government says no more Bitcoin. That's how the tulip bulb, my very smart mentor Ed told me, the tulip bulb craze cracked when the government banned selling of tulip bulbs. So right now it's pretty hard to buy Bitcoin. It's sort of surviving and thriving nevertheless. But I think for it to become more mainstream, if Amazon took Bitcoin, or if they made their own coin, or some of those things would make it a lot easier to use Bitcoin. Governments are sort of by their nature going to be anti-Bitcoin, so it'll be interesting to see how that plays out. I actually don't have any Bitcoin right now, so I'm looking for better ways to buy it in bulk, which I found, again, to be very, very, very difficult. So in any event, and a lot of people have been trying to help me get Bitcoin, and it's been very painful. Anyway, my great rabbi friend asks, why would a CEO with a really good background join a company if it's destined to fail? He's clearly talking about Axovant. Successful CEOs get things wrong all the time. That's why a lot of them don't end up having a great second act or a great third act. And I would name names, but it would be a little callous. But you can think of a lot of pharma CEOs that have done really well, and then they go try to do their second thing and they don't do so well. So I think that, it's in fact, I've hired many of them, or worked with many of them. It's just not easy to get, there's so few great drugs. It's not easy to get many great drugs. I think that, having a great CEO like Mr. Hung, Dr. Hung, it'll allow the company to withstand, a failure. If that drug, Interbidine, were to fail, they'd be able to withstand the failure. In fact, Dr. Hung, when he ran Medivation, he had an Alzheimer's drug fail and he had a prostate cancer drug succeed. So I think that it's not a huge issue if Interbidine fails over the really long term, because Dr. Hung and his capital source are pretty stable. So as long as Dr. Hung's committed to the company, Interbidine is just one product. That's sort of the theory there. It doesn't mean, and certainly, it helps the chances of success that he's joining the company, but, I don't pay too much stock into the fact that Dr. Hung is at the company. I don't think that changes whether or not the drug works. Jack Hall asks, when do you disclose positions or not? I think people are too sensitive about this stuff. Carl Icahn or Bill Ackman or Warren Buffett, nobody's success ratio is good enough that simply disclosing their position will change anything, in my opinion. There's only a few times where it makes sense to do it. For instance, the first is when it's a very illiquid stock. When stocks are very illiquid, it's very hard to build a position, and you just don't want to be competing with others to build a position. If you're not sure that you want to be in the stock, sometimes disclosure is a pain in the neck because you're sort of gambling, if you will, in the marketplace, and you're not 100% sure, so you kind of don't want the embarrassment if you change your mind. Not just the embarrassment, but you don't want people to follow you if you change your mind. That's why this is a new secret short, is because I might change my mind, and I don't want people to think, I've changed my mind. It's easy for me to change my mind in the marketplace. I press a button, or a couple buttons or make a few phone calls and all my positions go back to zero. But if a bunch of you started to follow my secret short, then it's sort of a pain in the neck because somebody's not going to see the next podcast and they're going to get, if I change my mind, it's because I'm not confident in the short and I don't want anyone to get hurt on that. The last time where it doesn't make sense to disclose position is similar to the first time in terms of liquidity. It's when you try to buy out a company completely. The last time I bought out a company in the public market, it went from $1 or $2 to $20 or $30. Of course, then I get arrested and that stock's back down to where it was or even lower than where I got arrested. Or when I bought it. So, for me, I have to be very careful about that if I'm trying to do something strategic with the company. So I'm a little bit more cautious because I moved the market quite a bit in that situation. It was really a historic and strange thing, especially made even more historic by the government's ill-advised actions shortly thereafter. Edward asked if studying an industry is so important, how do you study the history of pharma? Well, you can certainly buy old books and things like that, read old articles, old magazines, old scholastic journals. I think is very important. The other way is to just start now. 20 years from now, 20 years ago will be history. Today will be history. And so you do your best to kind of look backwards, but there's no time like the present to begin sort of learning the stocks. And that's why I do things like I trade in these really small sizes because I'll learn something about Weibo and Tableau that I can apply maybe 10 years from now. So it's worked out for me in that way. Well, higher borrowing costs won't cause an economic slowdown. Colin asked me about some comments I made kind of on a Periscope maybe a year ago even. And obviously higher borrowing costs will slow the economy. But the thing about borrowing costs is that the Fed doesn't set borrowing costs. Borrowing costs set the Fed. It's sort of understanding that relationship is one of the keys to finance, and whether or not the government is setting rates in reaction to the market, or the market setting rates in reaction to the government is an oft-debated thing. Companies can when I'm parting with my money, I decide what interest rate I give, right? And the borrower decides to accept it or not. And I've borrowed money at rates way higher than the Fed because I thought it was worth it and the lender thought it was worth it. And there's going to be deals where you lend money to people at rates lower than the Fed and you do it because it's worth it. So borrowing costs are vaguely set by the Feds, but not completely. They cannot completely control the economy. And that's been written about and talked about way more than just me. All right, we're wrapping up here. The Alzheimer's study from Axovant's coming soon. I've made 2 long videos on my first takes on the drug. They're very long. They're full of interruptions. I'm going to make an abridged version that takes just the conclusions, but if you want to watch the long versions, go right ahead. The long version's on its second video. I'm going to make the third video soon. I don't know how many videos there'll be. Maybe I'll keep making videos until the results come out. They're due by the end of the month. So who knows, maybe they'll come out on Monday. But I think they'll be out closer to the end of the month. So get ready to make some crazy paper because the Axovant trial result is coming soon, and I'm pretty much set on my recommendation. I have some more things to think about, but I feel pretty confident in what my recommendation will inevitably be. I'm going to be putting all my financial models, except for anything obviously where I'm acquiring the company in a strategic deal or something like that, or trying to acquire the company, so only sort of sanitized models without any insider information or anything like that, on a Google Drive, and you can comment on the models, and if you're really a long-term friend of the series, you can even edit the models. So I've only put a few on there. I think I put Pfizer, Merck, and Johnson & Johnson, but over the next week or two I'll put a few hundred of my financial models there, and what'll be fun is that we can actually work on them together as sort of a crowdsourced thing. So it'll be great to sort of learn and profit together on our forecasts, because I think the group work of many can outweigh the work of any one individual, and I think that a lot of people on Wall Street don't have this approach, so this will be one of the first times anyone's ever done this. Is kind of a Wikipedia for financial models, and it's just connected to my Google Drive, so if you have any thoughts on that, please let me know how to make it better. What am I doing lately? I've been reading 3 different books, including what's over 1,000-page book on Introduction to Algorithms, which I think I'm going to just be reading over a very long period of time. I did finish the Mythical Man Month, which is a really wonderful book on computing history. Highly recommended if you care about software engineering. Do not recommend it unless you really care about software engineering. I'm still reading this book on React. React is a core technology at my new startup, so I'm really reading it really slowly and really trying to absorb every word. And I'm reading a book called Designing Data-Intensive Applications, just about scaling different websites, and pretty interesting read. Selling the Wu-Tang album is, believe it or not, a really big labor, so I'm looking forward to getting rid of that. And we'll have more things in the near future that'll be really interesting, so stay tuned. Any suggestions on how to improve this series are more than welcome. I know some people mentioned that they didn't like the sort of big movers for the month. That's just a natural part of my own framework and how I look at things. So I think I'll do that maybe like once or twice a month instead of every week. And then I think that I'm going to add a few more things that I look at in my own day-to-day. Like I started to add the sort of IRR stuff, which again is more important to me than the actual return. Because IRR is a meter for just how strong your investing is. And the return is just sort of how much have you applied your investing to the actual markets, which matters a little less, I think, than IRR. And IRR is a much safer way to test out if you're a good investor or not. And again, I would encourage you to look at IRR. It's also known as annualized return, and all the adjustments you can make to divine what your real strong annualized return is. So anyway, I've given some videos on that, and I continue to try to refine this to really match sort of my own mindset and how I look at and think about things. But if there are parts of it that you don't like, or you think there are parts of it that are better than others, or you think there are parts of it that are missing, please feel free to reach out and send me an email. I'm hiring for about 10 different jobs. One of the jobs I desperately need is an administrative assistant. This job is only available to people in New York. It's a low-level, low-paying, entry-level job. So don't apply if you live in Saskatchewan or Germany or something like that. If you live in the New York area and can commute easily, that's a job there. For the investment analyst and programming jobs, most of those programming jobs are for Godel. There are a few jobs open to be an investor to work with me on my portfolio. Anyway, also try Godel Systems. I'm on there pretty much all day, all week, available for any stock questions whatsoever. It's a really cool app. It's my main focus right now. It's about 80 or 90% of my time. Thanks so much. I'll see you all next week.